Let's talk about how to overcome common e-filing issues and tax return rejects. Today we're going to talk about e-filing. Let's talk about filing compliance. Many times you'll have a delinquent filer come into your office and they want to know, how many tax returns do I need to file? Okay, how far back do I have to go? The answer is generally 6 years. So the IRS considers 6 years for going back 6 years to be compliant. Okay, you're not going to be able to e-file all of those, obviously. You can only e-file going back 3 years with your professional software. Anything older than that has to get sent in on paper and processed the old-fashioned way. For unfiled tax returns, generally, we go back 6 years. The 6-year period starts on January 1st of each year. So if you have, for example, a person who comes into you and they haven't filed for 10 years, okay, you would file 2016 through 2021. When January 1st rolls around, the 2016 year falls off, and then you would file 2017 through 2022. Does that make sense? Okay. Now, the policy statement, if you need a citation for this, if somebody asks you, how far back do I have to go? And they want proof of what you're telling them, it's IRS policy statement 5-133. This is in the Internal Revenue Manual, but if you Google this, it'll come right up. And it says a taxpayer must have at least 6 years of tax returns filed with the service to be considered in compliance. That's in quotes, okay? Enforcement beyond such a period can occur, but will not be undertaken without prior managerial approval. Okay, now I want you to understand that this is just for the IRS. Some states can go back a lot farther than this. For example, if you have someone who's a California resident, you basically need to file them all. Okay, and I have experience with that because I lived in California for the majority of my adult life. My husband and I moved out of California in 2016. But, you know, I still have clients in California and I do tax returns for Californians. But California is one of those states where, you know, if there's tax returns out there that are unfiled, it's best to just file them all. Okay. So what we're talking about here is just federal. But of course, you know, if you live in a state without a state income tax like Florida or Nevada, then you go back 6 years generally, and then the IRS will consider you in compliance. Now, as I said, it is possible for the IRS to go back further than that. They generally won't do it without prior managerial approval. It is possible for the IRS to insist on more than 6 years. That'll happen sometimes if the taxpayer has maybe fraud in the past or a very large amount of unreported income. Sometimes you'll have a situation where the IRS has filed an SFR, which is called a substitute for return, based on the information that they do have about this person. The taxpayer is what I'm talking about. And sometimes it'll behoove you and the taxpayer to go back further than 6 years if you can actually lower their tax liability. Now, they're not going to get a refund, but if the IRS thinks that they owe $15,000 on a really old return, right? It thinks that they owe $15,000 on a 2007 or 2008 return, and you know that the taxpayer didn't owe that much, or maybe they were even owed a refund for that year based on their filing status, or based on the number of kids that they have, or dependents, or whatever, then yeah, file that tax return. Eliminate that tax liability if the IRS is still collecting on that year. It's better for them if you do. But in compliance for the IRS is 6 years. Okay? Now, as soon as you file 2022, this upcoming filing season is what I'm talking about, then 2016 will fall off. This is only for IRS purposes. Once again, your state requirements may be stricter. Okay? So for IRS purposes, 6 years for compliance, and it's IRS policy statement 5-133. If you have a taxpayer that comes in, they're a delinquent filer, okay? You pull their transcripts, right? You pull their IRS transcripts, and then you file back 6 years. Most of the time when people are delinquent filers, that's what you have to do. They're not going to have their W-2s. They're not going to have their records. They're not going to have anything because let's be honest, usually when you have a delinquent filer and they haven't filed 6 years, their records are terrible. So you file an 8821 or a 2848 if you're an enrolled practitioner by that time, and you pull their records. What you need to request is their wage and income transcripts, and then you're going to file their tax returns, their delinquent tax returns based on what's on their transcripts. Okay, that's what you do. Next one, filing to replace an SFR. Now, an SFR is a substitute for return, and this is basically when the IRS has requested a tax return from this person. They've sent them notices and notices and notices. The taxpayer never bothers to file one, so the IRS says, okay, you're not going to file a tax return. We're going to file one for you based on the information that we have, and that's an SFR, a substitute for return. Okay, I understand there's a 6-year tax return policy for filing taxes, which we just talked about, but do you know of any exceptions that would require an individual to go back farther than 10 years? Yes, and that is if you want to replace an SFR, if a fraudulent return was filed, or if the state SOL, this is the statute of limitations, is longer, if there's a licensing issue at stake, if it's a corporate entity and they have to dissolve and the state won't let them unless all the returns are filed. Sometimes that'll happen too. Remember, a corporation has a filing requirement as long as it has existence. We're not talking about individuals now. Individuals don't always have a filing requirement. You understand that, right? If you have an individual human person, a natural person, if they don't have any income, then they're not technically required to file, right? I always recommend filing every year for everybody. I even file tax returns for my kids, okay? If they don't have any income, I put $1 on the income, on the return, and I file it for them. And you know why I do that? Is because ID theft can happen to anybody. I've seen it happen to kids. I've seen it happen to adults. I've seen it happen to retirees that didn't have a filing requirement. So the only way to really prevent a fraudulent return from being filed is to file one yourself, all right? But sometimes people will not have a filing requirement if they're under the income filing thresholds, or if they have no income, they don't have to file. That's not the case with corporations, though. Corporations have a filing requirement as long as they have existence. And some states are real sticklers for this, like California happens to be one of them. They won't allow the corporation to actually dissolve most of the time. There's some exceptions, there's some legal exceptions, but most of the time they won't allow the corporation to dissolve, formally dissolve, unless all the tax returns are filed. So that can be a hassle. And then, as I mentioned in the last slide, California also has a 20-year statute of limitations for collection. So if you do have a California resident and they come into you and they're a delinquent filer, generally it's best to file all the tax returns going back as far as you can basically get the records, because California will never leave them alone. But for IRS purposes, 6 years is what the IRS considers to be in compliance. And then if you do have a situation where the IRS has filed an SFR for that person, a substitute for return, and you know that you can get them a better tax result looking at their records, then do it, file it. When you have an original return and you want to replace an SFR, an original return means that that's the return that the taxpayer is filing. They're filing it. An SFR is a return that the IRS has filed because they've been bugging that person to try to file that tax return and the person never filed one. You can replace an SFR with an original return. You mail it, okay? It's never going to be a return that you can e-file, basically. I've never seen an SFR filed when you're still within that 3 years because the IRS wheels are really slow to turn. So generally, when you're sending in an original return to replace an SFR, it's going to have to be a paper filed return, and you got to mail it in, and it's got to go snail mail by the regular mail. you're going to mail it to the same address where a 1040 would be mailed for that person. But if you're probably, what you're doing when you're filing a delinquent filer is you're going into your older computer, right, with your older software. You don't want to go off of whatever address is in your software. You're going to want to look up the most recent address on your in Google or on the IRS website or in the most recent version of your software, because the IRS has closed tons of campuses. You want to make sure you're using the correct address, and don't go off of what your old software is telling you. If you're filing a 2012 return or a 2010 return because this person is a massive delinquent, has tons of old returns that you need to file, make sure you're using the most up-to-date address. So use the up-to-date address that's in your 2022 software, or go onto the IRS website and look up the address that you need to mail it to and use that one. Whatever address your software is generating, if you're using a very old version of your software, there's a good chance it's not the correct address. Okay? At the top of that paper return, you're going to want to write in red ink or in black ink, but then you highlight it, SFR protest, if you are replacing a substitute for return. And this is something that you can find out by just pulling the taxpayer's transcripts. All right, it'll say on the transcripts that it's an SFR, but once you become an enrolled practitioner, you can also call the practitioner priority line. To be honest, that's what I do. All right, that's what I do. I file a 2848, a power of attorney. I go back 20 years on that power of attorney, especially if it's California resident or if they've ever lived in California. It's something that you need to know, right? Go back 20 years and you call the practitioner priority line, you fax them that 2848, and you say, look, I need to know what's going on with this person. They just walked through my door. Can you tell me how many years I've got to go back? When was the last return that they filed? I need to know. And they'll tell you. As long as your power of attorney covers all of those years, they'll tell you. They'll say, okay, so this person filed, the last return they filed was in 2015 or 2007. This is how many years you need to go back. There's an SFR in this year, da-da-da-da-da-da. All right, the practitioner priority line will tell you. And once you become an enrolled practitioner, once you become an EA, you're going to be doing a lot of this work if you want to. All right, you can always tell a delinquent filer no, but it's a great way to make money. And most of the time, I'll tell you the truth, delinquent tax returns are easy. It's just that these people their lives are usually a mess, all right, if they've got 10 years of unfiled returns. And you got to do a lot of hand holding, which is why I don't like doing this sort of thing. But it's not difficult to do. You pull those transcripts, you contact the practitioner priority line, you find out what's going on, and then you just start filing those returns and mailing them in. And that's how you do it to get the person in compliance. Multiple EFINs. So I recently received a question about EFINs. The EFIN is an electronic filing identification number. That is the number that you need in order to e-file tax returns through professional software. Okay, EFIN. You can request an EFIN anytime. You don't need to be an enrolled agent. You don't need to be a CPA or an attorney in order to request an EFIN. Anybody can request an EFIN as long as you have filing compliance. You know, the IRS will check to make sure that you're in filing compliance. And as long as you have a clean background and a valid social security number. All right. If you don't have a valid social security number, if you're not a U.S. citizen or a green card holder, then you cannot request an EFIN. You can request a PTIN, but foreign preparers who don't have a social security number cannot request an EFIN. The responsible official of the EFIN that applies for the EFIN has to have a valid social security number. Now, you can have more than one EFIN account. I have never had more than one EFIN. I personally have had one EFIN my entire practice career. I requested it basically when I first started in this business. I was just a bookkeeper at that time, and I was doing tax returns in California as an unenrolled preparer. I didn't become an EA until a few years later. But you can have more than one EFIN. Because the EFIN is tied to the location I always just used my home address when I applied for the EFIN. I used my home address. I used my legal name. I didn't have like a corporation or a partnership, and I didn't have like a business name like Christie's Tax Solutions or anything like that. I just used my own name on the EFIN application. I used an EIN for my sole proprietorship, which I got right away. And that's it. That's all I did. The only thing that was a little bit difficult when I requested my EFIN was I wasn't an EA when I requested my EFIN. It was just at the very beginning of my career, and I had to request a fingerprint card and go down to the police station and get fingerprinted. I've discussed this before. Now I think the IRS is switching to live scan, but you still got to go get fingerprinted if you're not an enrolled practitioner. So if you're very close to getting your EA license and you don't have your EFIN yet, you might want to wait until after your license is issued. From what I hear from other users in our forums, they're getting their EFIN very quickly, in less than a month, once their EA license number is issued to them. So it's much quicker. When I requested my EFIN, it was before I was an EA. I had to go get fingerprinted, and then it took about 60 days for them to process my EFIN application. But you can potentially have more than one EFIN. It's not like a social security number where you only have one. So an EFIN is tied to the location. And if you're like working out of a home office, you would just use your home address. It's very easy. But for example, let's say you do have a tax office and it's taking off and you're going to open another one. Then you could request another EFIN for the second office, and you would be the responsible party. If you were the owner of that business, you would be the responsible party on both of those applications. But then you could have two EFINs. Like, let's say I have an office in one city, and then I have another office in a neighboring city. Then you can request an EFIN for both of those offices. But as a preparer, you can only have one PTIN. Your PTIN is your preparer tax identification number, and you can only have one of those. It's just like your social security number. Okay? And if you want to know, here's a little bit of tax trivia. In the older tax returns, we used to put our social security number in the preparer section. A lot of newer preparers are kind of shocked by that. But back in the olden days, this ID theft stuff just wasn't a thing. People used to put their social security numbers on their checks, on their personal checks. They would have their social security number pre-printed. It just was not an issue before the internet. Yes, I'm showing my age. But when I started this business, when I started being a bookkeeper, and I was a California registered tax preparer, it used to be that you would put your social security number in the preparer section of the return. And I'll show you an older tax return. You can see right down at the bottom, it says social security number or PTIN, because back before the PTIN was a thing, you would put your social. There were a couple of years in there where the PTIN was not mandatory. Some preparers, some of the older preparers especially, kind of pushed back on that. They didn't want to have to request a PTIN. They felt like it was the government was tracking them or whatever. But now newer preparers kind of understand it's a lot better to not have to put your social security number on a tax return, right? You don't want your client to know your social security number. I mean, you know theirs, but I want to give out my social security number to as few people as possible, right? So I requested a PTIN really early on, but back before PTINs were a thing, preparers used to have to put their social security number down there in the preparer section. So you only have one PTIN, all right? Your preparer tax identification number is just one. You only have one because that's tied to you, all right? That identifies you as the preparer. But the EFIN, you can have multiple EFINs, all right? So if you open up a second tax office, you can have a second EFIN. And the EFIN, you could change the address on your EFIN. And you could you log into your EFIN account on IRS e-services, you could change the address on there, all right? So you could change the address on your EFIN, just like you can change the address on your PTIN account, but it's two different places where you would do that. And I think I might do a video about that later, because I have a lot of people asking me how to change all of these numbers. So I'll do a separate video on that. But you can have multiple EFINs, you can request multiple EFINs, but you can only have one PTIN. Okay? All right. ID theft and IP PIN. So you might have a taxpayer that has been issued an IP PIN by the IRS automatically if the IRS flags their account with potential ID theft. What ends up happening is the IRS will send them an IP PIN in the mail. Sometimes taxpayers won't get that. Okay? Sometimes taxpayers will request their own IP PIN and then they will lose it. So that will happen sometimes too. In this case, the tax practitioner said that their taxpayer has been a victim of ID theft, tax-related ID theft, which means in the past, someone may have used their social security number to file a fraudulent return. It's happening to a lot of people, and sometimes you won't even know that that sort of thing is happening until the following year when you go to try to file your tax return, and it tells you that a tax return has already been filed for this person. It's a bad situation. But it's not the end of the world. What ends up happening is if you do have someone who either has a fraudulent return that's already been filed for them, or if you have a person who was issued an IP PIN and they lost it, they can try to contact the IRS in order to get the IP PIN reissued, but sometimes the IRS won't be able to get it to them in time, or the taxpayer just won't be able to verify his identifying information with the IRS well enough to the IRS's satisfaction for them to have the IP PIN reissued. The solution is to just mail the tax return without the IP PIN. That's what you have to do. You mail the tax return without the IP PIN. You mail it using regular mail, certified mail. They have to go down to the post office, fill out that certified mail card. That's what I recommend. Yeah, okay, so it's not mandatory for it to go certified mail. You can just mail it with the stamp. I never, ever recommend that. I can't even tell you how many times that certified mail receipt has saved me and the client. But yes, I always recommend going certified mail, but you can always just mail it with just regular mail with a stamp if you want to save the $3. But you just mail the returns without the IP PIN. It will increase processing time, but if it's a situation where the taxpayer has to file the tax return on time and wants to avoid a penalty, then you could just mail it right on April 15th, right on the filing deadline, if the e-file has already been rejected. All right, so that's what you got to do. And you have to give them a realistic processing time. Mailed returns are taking a really long time to be processed right now. The IRS is still very backed up, and it can take more than 6 months for that tax return to process. But if it's mailed on time, even if the taxpayer has a situation where they included a check because they owe tax, that payment is on time and that tax return is on time if you mail it by April 15th. There is not going to be a failure to file penalty on that tax return as long as you have that certified mail receipt. Okay? So you can mail the return without an IP PIN, even if it's giving you an e-file reject. That's the solution. Okay? And it might not be the solution that the taxpayer wants to hear, because taxpayers want all of these things to be done immediately nowadays, because they always expect immediate satisfaction, especially if they're younger and they've been e-filing most of their life and they're expecting to get the refund or whatever in 2 weeks. That ain't going to happen if you mail it in. All right? The processing time is going to be maybe 6 months, maybe even more. I've had some, especially delinquent returns, take even a year to process. I know that that's not what they want to hear, but that's the way it is. Okay, but that's the solution. If you have a person who has ID theft or an IP PIN that they've lost and you can't get it to e-file, you've got to mail it in. Filing extensions without permission. So I've had a couple of people ask me about this. Do you need the taxpayer's permission to file an extension? And the answer is yes. I have several clients who don't ever talk to me. Okay, they've been chronic delinquents in the past. They always want to act like the IRS doesn't exist. They hate to think about it, I guess. I don't know. They never talk to me. They don't communicate with me. And I just extend them. Now, I want you to understand that this can get you in trouble. All right? This can get you in trouble. It is possible that the taxpayer can call you and threaten to sue. And they can sue if they actually were harmed by you filing an extension. The most common problem that I have heard where this will happen is, let's say you have a client and they've been your client in the past, they get disgruntled with you or whatever, and they don't communicate with you anymore, and they want to go to another preparer, but they don't ever tell you. All right, they ghost you. I guess that's that's the term for when somebody just doesn't answer any of your calls or texts anymore. That's what the youngins say. They say he ghosted me or she ghosted me. Okay, they don't communicate with you anymore, and then they go to another preparer, but you've already filed an extension for them. That can be a problem because that preparer might have wanted to submit a payment with the extension, and now they can't do it anymore because an electronic payment rather with the extension, and now they can't do it anymore because you've already filed an extension for them, and you can't file 2 extensions for the same person in the same tax year. So this is a legitimate thing that can happen. Yes, you have technically violated a rule under Circular 230 because you need to have the taxpayer's permission in order to do this. So just realize that I myself am guilty of this, but yes, you can possibly get in trouble for this. You should always have permission to file an extension for the client. The extension can extend the statute of limitations for additional assessment from the IRS. The IRS has 3 years from the filing due date to assess additional tax. Basically what that means is the IRS has 3 years to come in and audit the tax return that you filed. Generally, it's 3 years. It's 6 years if they believe that you've omitted more than 25% of your income, but that's rare. I've honestly only seen that like once or twice in my entire career. So it's usually 3 years. The IRS has 3 years from the due date to assess additional tax. If you file an extension, then that also extends the amount of time that the IRS has to assess additional tax. So instead of being April 15th, now it's October 15th plus 3 years, all right, for the IRS to come in and audit the taxpayers. So if you haven't been given permission to file that extension, then they could come after you and say, you never got permission from me to file that additional extension. I've never heard of that happening, but that's the truth. It extends the statute of limitations for that particular year for additional assessment. And then, according to Roger Nemeth, EA of THS, that's Tax Help Software, he does a lot of classes on CPA Academy. And if you do actually hear of a course from Roger Nemeth, I do suggest that you take it. He's great. Once again, I don't get any kickbacks from Roger Nemeth or Tax Help Software or anything like that for mentioning him, but he's a great instructor, and I've learned a lot from him about this type of complicated rep work, how to read transcripts and that sort of thing. Now, according to Roger Nemeth of THS, Tax Help Software, filing an extension without the client's permission could subject the taxpayer to not being able to file for bankruptcy against tax owed as early as they might have been if you hadn't filed the extension. Okay, so this is a bankruptcy tax law thing. This is a situation where maybe you have a taxpayer who is getting ready to file for bankruptcy, and maybe they already have a tax attorney that they're working with or a bankruptcy attorney that they're working with. Bankruptcy filings are done by lawyers. You understand that, right? It has to be done through the courts. You're never going to be doing any of that unless you actually are a lawyer yourself, right? So enrolled agents don't file for bankruptcy. That's an attorney's purview. But the bankruptcy itself is something that's done through the courts, and then that creates a bankruptcy estate. Now, a bankruptcy estate does have to file tax returns. We talk about that in the estate tax law chapter. An estate of a deceased person is not the only type of estate that exists. Bankruptcy estates are also a thing, and bankruptcy estates file the Form 1041. Okay, it's a type of estate. And if you look at the tax form 1041, the bankruptcy estate is one of the check mark boxes up there of the type of entity filing that files a Form 1041. Okay, you might never do one of those in your entire career because it is a specialization. But if you file an extension for a person who is planning to file for bankruptcy and they want to file for bankruptcy and they're already working with an attorney, and you file an extension, then it may prevent them from being able to file for bankruptcy, wanted to plan to file for bankruptcy, and you filing that extension might put the kibosh on that. This could be a situation where, yeah, you might get sued for this because this is actual harm, and this is something that you can't fix after the fact. So you can't take back an extension that you filed for somebody. Once it's done, it's done. So in general, I advise you to get permission from the taxpayer to actually file an extension. Okay, because you can cause actual harm. And this is especially true if this is a situation where the taxpayer has left your practice, doesn't plan to use you anymore, and has gone to another tax professional. And now that tax professional wants to file an extension for them and submit a payment. Or, God forbid, they want to file for bankruptcy and they're already working with a tax attorney to file for bankruptcy, and you file an extension for them, and now they can't file for bankruptcy anymore because of something that you did. All right, you don't ever want to be in that kind of a situation. So if you are going to file an extension for somebody, get permission. Get a text from them, get email permission, or call them. Or have, if you work with staff, have your secretary or your administrative assistant contact that taxpayer and say, do you want us to file an extension for you? Okay? That's just good tax practice. Okay. Canceling auto debit on an IRS IA. So an IA is an installment agreement. That's an IRS payment plan. So this is a situation where this tax professional has a client who is making payments on an IRS debt. That's an IA or an installment agreement. Okay. Her question is this: my client's business in Fort Myers Beach, Florida was wiped out by Hurricane Ian. There is nothing left. What is the fastest way for me to stop her automatic debit for her existing installment agreement from coming out, since there are no funds coming in with which to pay it? So she has an auto debit installment agreement, and those are really common. The IRS will just take the money out of the taxpayer's account. An auto debit agreement is generally preferred because when you have to write checks and pay it that way, or when you have to do it through online payment methods like direct pay, then that's the taxpayer having to do it themselves. If you just set up an auto debit, not only is the application fee for the installment agreement cheaper, but then the taxpayer doesn't really have to remember to do anything. The IRS will just take that $100 or that $200 out of the taxpayer's account automatically. But in this case, the taxpayer has been the victim of a huge casualty. Their business was completely wiped out. There's nothing left. And now the tax professional and the taxpayer want to stop this auto debit from coming out of the accounts because the taxpayer doesn't have any money coming in. Their business was destroyed by this natural disaster. Should I call PPS? That's the Practitioner Priority Service. Call ACS. That's the collections, IRS collections. Should I have her zero out her bank account? These are extenuating circumstances, and we in Florida are declared a federal disaster area, and all our tax deadlines have been moved from October 17th to February 15th, which is true. The IRS did extend all of the deadlines like they do for most natural disasters. When it's a federally declared disaster area, taxpayers will generally get additional time to pay as well as file their tax returns. All of their deadlines have been moved, and they've been extended to February. And this person basically doesn't have a business left. So she wants to stop that automatic debit because she needs that money to basically live, to buy food and pay her rent and everything else. And she doesn't have any money coming in. So to be honest, the best way to do it in this case is to call her bank and get the auto debit blocked. Okay, doing it through the IRS is going to take longer if you do it through official channels. And this is an emergency, okay? She should call the bank and get the auto debit blocked through her bank. She can always set it up later again, after everything has been like settled and she gets a new place to live and everything else. But right now this is an emergency, right? So she needs this money to survive on. So you call your bank, get the auto debit blocked by the bank, okay? And it's also a very good idea for the tax practitioner who's representing this person to get a Form 2848 and contact the Disaster Relief Hotline. They're very, very helpful at the Disaster Relief Hotline, amazingly enough, because the IRS's regular customer service is not that great. And even PPS, the Practitioner Priority Service line, has been very, very backed up. There are many days where I can't even get through at all. Although if you do call very early in the morning, that's your best bet. Like right at 7 a.m. when they open. At 7 a.m., 8 a.m., right in the morning. By lunchtime, you can forget about it. It's like you've got a 2 or 3 hour wait. Many times you can't even get through and it'll say the lines are too busy and you'll get a courtesy hang up. Okay? But you can contact the IRS Disaster Relief Hotline. The easiest way to find that is to look up the tax relief page and look up that particular disaster. The number will generally be listed on there. For Hurricane Ian, which is the most recent disaster that we've had in Florida, the number is right there. It's 866-562-5227. Contact them. You mention that the taxpayer has been a victim of this disaster. They lost their business. They were in a payment agreement. Can you help the taxpayer with anything? They'll flag the taxpayer's account. And then remember, when you are filing this person's tax return, if the taxpayer actually does move out of the disaster area, which is not uncommon, then you are going to have to request relief after the fact by calling the IRS if they do get a penalty notice. Or the other solution is to file the taxpayer's return on paper and write in the name of the disaster at the top in red ink, Hurricane Ian, and then the disaster number that you can get from the FEMA disaster page. But either way, you can abate their penalties, you can request relief, you contact the IRS directly, and it's the IRS disaster hotline that you need to contact, all right? But if you have a situation where the taxpayer does have an installment agreement and they have an auto debit, the money is being taken out of their account and they have this horrible disaster that happens to them, whether it's something like this, where it's a federal disaster area, or whether it's, a disaster that just happens to them, like just their house burns down and now they can't afford anything because they've had this horrible disaster happen to them specifically, the easiest way is to call the bank and get the auto debit blocked if it is an auto debit, okay? And then you have to be in contact with the IRS and tell them what's going on. Contact Practitioner Priority Service, contact collections and let them know, I've had this thing happen. The taxpayer has no money to live. Their business has been destroyed or their house has been destroyed. They can no longer pay. And many times the IRS will put them into a temporary hold, whether it's 30 days or 60 days. And then, if the disaster is bad enough, then they might even qualify for the status currently not collectible, or CNC. Okay, so just, these are collection alternatives, and you can learn more about these. There's many classes that you can take out there to learn about collection alternatives and how to do representation work when the taxpayer does have a very serious issue like this. But with regards to canceling an auto debit, when the taxpayer has an installment agreement, the easiest way to do it is just call the bank first. Get the auto debit blocked, and then contact the IRS with whatever, and notify them, let them know with what has happened. And if it is a natural disaster like this, like Hurricane Ian, you contact the disaster relief number specifically, and they're always very helpful. Okay? All right. So that number would be here, and you can find this in the disaster relief section of the IRS website. Okay. E-filing delinquent tax returns. This is a question that I get really frequently from newer preparers. Okay. Professional tax software, the software that's for professional tax preparers, where you're filing with an EFIN. We're not talking about consumer software or DIY software, which do it yourself. That's like TurboTax. Okay, that's not what I'm talking about here. We're talking about tax professionals. You can file up to 3 years in the past and e-file those returns. Okay, so up to 3 years in the past. Once it's been more than 3 years, if you're filing a tax return that's more than 3 years old, then those have to go in on paper. Okay, they have to be paper filed and mailed in. Okay, so e-file for professionals are only available for the current and past 2 years. Now, if you have consumer software like TurboTax, something that the consumer buys, then generally they can only e-file the current year. You as a tax professional are not supposed to be using that software. You can get into big hot trouble using that kind of software, because that kind of software, consumer software, does not generate the 8867, the paid preparer due diligence checklist. Because paid preparer due diligence checklist, remember that form that is mandatory whenever you have someone who claims the earned income tax credit, whenever they claim the child tax credit, the American Opportunity Tax Credit, that form has to be attached to every single tax return that you prepare that has one of those credits. If that form is not attached, you can be liable for hundreds and hundreds of dollars of return preparer penalties for every return that gets filed that doesn't have that form attached. Consumer software will not attach that form automatically because that's a paid preparer due diligence checklist. That's only for paid preparers to fill out. If it's a taxpayer filing their own return, then they're filing that return under penalty of perjury, but they're filing it themselves. They're not using a paid preparer if they're using consumer software like TurboTax. You're not supposed to use that software, basically. Okay, if you're a paid preparer, you're supposed to apply for an EFIN, and you're supposed to use professional software like Tax Cut Professional, Pro Series, Lacert, Drake, whatever your favorite type of software is. Okay, when you have professional software, you as a preparer can e-file up to 3 years in the past. Anything older than that has to go in on paper. And every single year, right around November, the IRS will turn off or disable, or whatever you want to call it, IRS e-file for individuals. And this year, I think it's November 26th or 27th. They turn it off. You can't e-file after that date. And then they turn it on again in January when the new tax filing season opens. It always opens right around January 22nd, 23rd, somewhere around there. Usually it's January, late January, when e-file opens for that filing season. And then once again, you can file up to 3 years in the past. So I'm recording this November 7th. As of right now, I can file 2021. I can e-file that. I can e-file 2020. And I can e-file 2019. Okay, 3 years. If I want to e-file something older, like a 2017 tax return or a 2016 tax return, I can't e-file it. I can still file it, but it has to go in on paper. Okay? Okay, next slide. Delinquent filing with payments. I am trying to e-file a late 2019 return. You can still e-file 2019, people. So it's not that old. You can still e-file that one as of right now while I'm recording this. But this is a delinquent return, obviously. It's very late. It's 2019 return. And my professional software is not allowing me to accept the ACH direct debit effective date with today's date. So they're trying to do, I'm explaining this scenario, they're trying to do a direct debit with their software on a delinquent return, okay? Now, most software will not permit an ACH payment or a direct debit through your software when the return is delinquent, okay? I can't speak for every software, but my professional software doesn't allow me to do this. So, in addition, I don't recommend doing this. I don't recommend doing any kind of direct debit at all anymore, because this puts a responsibility on you as the preparer for the payment to be made and to be made on time, or by whatever date you are doing it in the software. It is a professional risk and failures are not unknown. There were several, at least 2, that I heard of in my professional groups last year, where the direct debit was supposed to be made through the software. They filed the return and the return went, but the direct debit was not made. And then the preparer ended up being on the hook for that. In both cases, the preparer ended up having to cough up money to pay for the penalties. Okay, I don't recommend doing this. I know that many of you do direct debits through your software, but just realize that this is an additional layer of professional risk when you do this. Failures are not unknown. I personally do recommend that you should tell the client to use direct pay instead or write a check. Now, it's come to my attention recently that there are some younger tax professionals who have never written a check themselves. But you can always write a check. There's nothing preventing you from doing that. You can write a check. And you don't have to order checks from your bank in any kind of large amounts. I did have a client ask me last year. They said, oh, well, I'm going to write a check and I'm going to just mail it in right on April 15th. They wanted to wait until the absolute last minute. And they didn't owe very much, but they wanted to kind of delay the payment as much as they could. They needed the money for something else, and they didn't want to basically zero out their bank account if they could help it. So I said, well, write a check and just mail it with the tax return if you want to delay it as much as you can. And so they wanted to do it that way. And they mailed the return on paper and wrote a check. And this was another California person that wanted to do this. And they owed a little bit, a couple $100. And I said, it'll still be considered on time if you do it this way. It's no problem. It's perfectly legal. So they said, well, what do I do? I don't actually have any checks. So I said, did you know that you can walk into your bank teller and walk in and just get what's called temp checks? And they charge you $1. My bank, I bank with Wells Fargo. Yes, I know they're terrible. I bank with Wells Fargo. But if you walk into the bank at Wells Fargo and you ask them for temp checks, they'll print you out 3 checks on a sheet. So this is what a sample looks like, and this is a fake check, but this is how you're supposed to fill it out. Temp checks are just printed by the teller, but they are printed on security paper, check paper, so it is a valid check. It needs to be printed on check paper. It's a special kind of ink. And they'll print them out for you for $1 usually. They'll just charge you $1, and then you've got 3 checks. And you could pay your IRS bill or your state tax bill with these checks and mail them in. And what you're supposed to do is you write U.S. Treasury Department. You don't write IRS. And then you put the form number and the year in the memo line, and then the taxpayer's social security number at the top. And you just either attach it to the payment voucher if you're sending in a payment voucher, or sometimes I'll just staple it to the front of the return. And that's how I'll send it in if I'm sending in a paper return, or if I'm preparing a paper return for the taxpayer to actually mail it. And then you send it in certified mail, and then you have proof that it was mailed on time as well as paid on time. And that's it, okay? Or you can use direct pay. Now, direct pay is fantastic. I love direct pay. It's free. It doesn't cost anything. It's very user-friendly. The only drawback to direct pay is that you have to have some kind of proof of the taxpayer's identity. And the way that they do that is they verify the AGI of a prior year tax return. And if the taxpayer doesn't have that information, then they won't be able to make a payment through direct pay. So let me show you what I mean. So let's go to direct pay. And this is an official government website. This is not a third party payor. Like when you make a payment on your IRS debt and you use a credit card, that's a third party. And that's why they charge you a fee. But if you use direct pay, this is the IRS that's taking the payment. Okay? You can't pay with a credit card. It has to be with a bank account. But this is completely free. There's no fees or anything. So I'm here on direct pay. And let's put that the reason for the payment is that it's a balance due. Like I'm paying my balance due for the tax return that I'm filing. Okay? And you can apply the payment to the correct year. So you put income tax. All right? Income tax is going to be the most common one. That's a Form 1040 for individuals. Unfortunately, you can't make business payments here, which means you cannot make a payment for a corporation. Like a C corporation cannot make a payment this way. Okay? Only an individual person can, which is unfortunate. I wish you could make C corporation payments this way. But if it's a C corp or another entity, then it has to be made through EFTPS. But individual taxpayers can pay their tax liability this way. So then you check the tax payment for, you select the tax year. Let's say it's a 2021 return. You could do a delinquent year here, people. So let's say if I'm filing a 2020 return or even a 2019 return, and I'm e-filing the return, but I'm making the payment this way, not using direct debit. You can guide the taxpayer with them just being in your office, right? But this way it's their responsibility and not yours, okay? So let's say I'm making the payment for 2021. Just go like that. Please confirm. Is this correct? Yes, it's for 2021. And then here's the verification. So they ask you to verify the filing status, the first name, last name, the SSN, date of birth, and then the address on that tax return. Okay, whatever tax return, you can use any of these years for verification, but they have to have at least one of these years. Or you're going to have to pull the transcript for these years and try to get the information off of that in order to let them pay with direct pay. Okay, so this is the big drawback to direct pay is you need to have some of this information in order to submit the payment that way. You have to have at least a prior year return. Going back, you can go back all the way to 2016 if you have that information, if you have the tax return in front of you. But if they're a delinquent filer with no records, then you can't do it this way. And you might have to break down and send them to their bank to go get a check. Okay? Now, just so you understand that I'm not lying about this direct debit failure thing, this is one of the cases that came up on one of the groups that I belong to. And this is an actual tax professional. I'm not sure what software he was using, but he said, I have records that the tax software transmitted the bank information for an auto payment with an extension. The IRS sent a failure to pay penalty saying that it was never sent. Has anyone successfully sent an abatement request showing the tax software transmittal records? Now, I've never had to do this, but this is really bad. This is the tax professional's fault. The taxpayer was expecting to pay through their software. He obviously offered, I can pay it for you through direct debit, and the software had a flub, okay? It says that it was transmitted. The IRS didn't take the money out of the taxpayer's account. And now he's going to have to jump through some hoops and request a penalty abatement. Now, this is one of the reasons why now I don't do direct debits anymore. And the other reason is the absolutely terrifying Osterwick District Court case, which had a similar fact pattern. The IRS really is going after these late filers even when it's an honest mistake. My opinion, here I put that I feel like it's counterproductive, because the court in this case said the taxpayer could have filed their extension on paper and paid their tax using a personal check. That's what the court said to these people. Kiplinger, which is a very reputable tax publisher, I do subscribe to the Kiplinger tax newsletter. I get it every 2 weeks or twice a month or whatever it is. That they did a summary of the case, which is a very good summary. What ended up happening is these people, these taxpayers, got a 6-figure tax penalty, hundreds of thousands of dollars. It was over $200,000 for a late filing penalty. They were very wealthy people. The tax preparer was actually a CPA. He submitted their extension with a payment, or he thought he did. The extension failed and the payment failed. So they had a failure to file penalty and a failure to pay penalty, and it was the CPA's fault. He thought that he had sent the payment, and he thought that he had sent an extension. They estimated the tax because they weren't ready to file, but it was $100,000, $200,000 payment, and the payment didn't go through, and the extension also did not go through for whatever reason. And the CPAs have to carry E&O, which is errors and omissions insurance. So I'm sure that the CPA's errors and omissions insurance stepped in to actually litigate this case. But the court didn't give them a pass. So the court said, well, it's your fault. You could have mailed in an extension and mailed in a paper check. And that's what the court said. And that was the IRS's argument too, which I kind of feel is a bad argument because the IRS really, really wants people to e-file. It doesn't want people to file anything on paper. And the IRS also doesn't want people to pay with paper checks. They don't like it. They're always pushing direct debit and e-file your tax return, e-file your extension, e-file your payment, use direct pay. The IRS doesn't want you to pay anything with paper anymore, right? Right. This is a big part of their marketing ploy. I get newsletters every week about it. Oh, do direct debit, e-file your tax return. But when push comes to shove, and these poor people went to court, with the CPA, like begging, can you please abate this penalty? We did try to send it. We have proof that we did try to send it. There was a failure. It was a software failure. Nope, they didn't give the taxpayer or the CPA a pass. And the court said you could have filed your extension on paper, and you could have paid it with a personal check. You could have paid it with a paper check. So that's how this case stands, and it's a very recent case. I don't know if the CPA or his E&O or if the taxpayers are going to fight it, but this was a 6-figure penalty, over $200,000 in penalties. You could read it. The content is there. The name of the case is there. I have it listed on your slide. But just realize that it's not a good idea to do this. Don't do direct debit. If anything, tell them to do direct pay. Maybe you could help direct them while they're in your website. But I personally am not going to be on the hook for this anymore. I have done it in the past. I'm not doing it anymore because of professional liability. And I don't want to be on the hook for a software failure, basically. Okay, whether I can jump through hoops later and get it abated, I don't even want to deal with it in the first place. So to be honest, the 2 or 3 clients that had kind of a situation like this year, I said, do a paper check, mail it in. And, the IRS, if they're going to litigate this way, then that's how I'm going to advise my clients. If the IRS is going to take this litigation position that, hey, we're not going to abate this penalty because you could have paid with a paper check, then guess what I'm going to tell my clients? I'm going to tell them to pay with a paper check. And I still do send extensions electronically, but I don't send them right on the deadline. I want you to realize that. I don't wait until the actual last minute. So the latest I will send extensions is the 14th of April. Okay, a day before. I will send an extension the day before. And then I always check my e-file reports in my software to make sure that that extension went through. And I also always check to make sure that I have an e-file postmark. Okay. I don't know how your software does it, but that's how my software does it. You check on my software. I check it's called the e-file transmission reports. I check that tab and I make sure that all of them went through for the clients, especially the ones that are always filing late. Okay. All right. So this is my advice to you. I'm not telling you what to do with your practice, but I'm telling you that this case is out there. It's kind of a terrifying case for tax practitioners in general, but this is the IRS is in the court's position now, okay? That if it's a e-file failure, that too bad, it's on you, and you could have filed a paper extension, and also you could have paid with a personal check. Now remember, you get that grace period. If you do have an e-file failure, you get that 5-day transmission failure period for individual taxpayers, and you get a 10-day transmission grace period. We talk about this a lot in the webinars part 3, all right? But that's after you get an e-file reject. In this case, I'm not sure if the CPA actually got an e-file reject or if he just tried to submit and he just wasn't paying attention afterwards. It didn't go, or it was a software failure, or maybe his internet went down. I don't know. But you're responsible for keeping tabs on that, right? It becomes a civil liability for you as the preparer if you're not paying attention to what you're doing. Okay? All right. So just be aware that this case is out there, and that's how it stands. Make sure you keep on top of all of your transmissions, okay? And then if you do have a failure, that you got to make sure you tell that client, you need to come in here, get the return on paper or get that extension on paper, and here's the check. You need to write it out, and you need to mail this by the deadline, certified mail. And that will protect you, and it will also protect the client. Okay, got it? All right. Okay, let's talk about extensions now, whether they have to go in as married filing separate or married filing joint when you have a married couple. Now, it doesn't actually matter when you have a married couple whether you file an MFS or an MFJ extension, although MFS extensions are always preferable if the taxpayers don't know whether they're going to file joint or separate. Okay, and I'm going to explain why. So the question is, I have clients that are separated but are still filing jointly as of last year. This year, the husband contacted me and asked for an extension, no problem, married filing joint, which I filed. Then the wife tells me after the fact that she will be filing separately. What do I do? So this actually happened to me recently. I had a couple, they've been separated for a really long time. They're like amicable and they're not divorced. So the husband contacted me and asked for a joint extension, which is no problem. I filed it. He's listed as the primary. Okay, that's important. He's listed as the primary, and I sent in the joint extension. Later, about a month later, the wife calls me and says that she's going to be filing separately this year, which is perfectly her right. It's, you can't, spouses can choose whether it's married filing joint or married filing separate. So she wanted to file separately. And I thought, oh boy, I've already filed the joint extension and she wants to file separately now. What I did is he was listed as the primary and I'd already filed the joint extension. What I did is when I went to my software, I created like a dummy return for her. You have to input them as a separate filing in my particular software. I know that some software will allow you to automatically split, like Lacert will allow you to automatically split a return to MFS returns if you have filled in all of the information for a joint filing. My software doesn't do that. So I have to put in the wife as a separate client, which I did. And I submitted an MFS extension for her and it went through, okay, because she was the secondary. Now, the reason why it's good to file 2 MFS extensions is because that way you have an extension for him and an extension for her, or if it's a same-sex couple, both of them, both spouses, and those 2 MFS extensions will cover both of the spouses no matter what they decide later. Okay, an extension is never binding. Taxpayers can always choose a different filing status than the extension when they later file. It's not an issue. Okay, the problem is that if you've already filed an MFJ extension for one of the spouses, let's say it's the husband, let's say you file an extension, it's a joint extension for the husband. Then later, if the wife wants to file a separate return, she certainly can, but the IRS computers will not pick up the second spouse on a joint extension. So then she will get a late filing notice if you file a joint extension for her with the husband if she chooses a separate filing afterwards. Okay, and the joint extension is supposed to cover them both, and it will legally, but then you have to call the IRS and go through the rigmarole of abating. you have to go through the rigmarole of abating that penalty, because the IRS computers are not sophisticated enough to pick up the second spouse on a joint extension if they both decide to file separate returns afterwards. Okay, you can get it abated. It's not an issue because the joint extension legally covers them both. But like I said, the IRS computers will not automatically pick up the second spouse if they do choose to file separate returns afterwards. Okay? All right, just so you understand. The extension is never binding. It will not bind them to any particular filing status afterwards. They can choose whatever filing status they want, joint or separate. But filing 2 separate extensions will save you the hassle of having to call the IRS after the fact and abate a penalty, a late filing penalty on the second spouse if you only file a joint extension from the get-go and then they later choose to file separate returns. Does that make sense? Okay. It's because the IRS computers are antiquated and they just won't pick it up. All right, they won't pick up that second spouse. So when in doubt, file 2 separate extensions for the 2 spouses, MFS extension for one, MFS extension for the other, and then they can decide to do whatever they want after the fact. All right? They can choose a joint filing or separate filing and you won't have to make any extra calls. Okay? All right. Extension with an NRA spouse. Now this is a little bit different scenario. This is a situation where you have a U.S. taxpayer with a social security number and they are married to a non-resident alien that does not have a social or a TIN. What do I put in the social security number field? Can it be e-filed? So this question actually came from another tax professional who asked me this. You can file an MFS extension for the U.S. taxpayer with a valid SSN, and it will cover them both when they file later, even if they file jointly. Okay? What happens a lot of times when you have a U.S. spouse that's married to a non-resident alien is they will not choose to file jointly with that non-resident alien spouse unless it's a situation where that non-resident alien spouse is going through an adjustment of status. An adjustment of status means they are currently in the application process with USCIS, which is U.S. Immigration, in order to change their status and apply for a green card. You can file a separate extension for the U.S. taxpayer and it will cover them both, even if they file jointly. Now, your other option, in this case, if you want to file a joint extension, or if the taxpayer wants to file a joint extension, if they push you for that, you're not going to be able to file e-file a joint extension if you don't have a taxpayer identification number in the second taxpayer's field. Okay. You always want to put the taxpayer that has the social security number first. I don't care if it's the husband, I don't care if it's the wife. Whoever has the social security number, you list them first, okay, on that extension. And then you can choose to put NRA for non-resident alien in the social security number field, or you can put applied for if you're in the process of applying for an ITIN or a social security number and it's currently in processing. And then of course you can always paper file the extension that way. Okay, so you put NRA or you put applied for in the social security number field if you can't e-file. Now there might be some software out there that will allow you to e-file an extension, a joint extension, if you put applied for or NRA in that second field, but my software won't allow me to do this. So this is what I do. So I either file an MFS extension with the primary, whichever spouse actually has a social security number, or you can also file on paper and you just hand it to them and you say, mail this in. Okay? All right, so those are your options when you have a non-resident alien spouse filing with a U.S. spouse or planning to file with the U.S. spouse. Okay, we've reached the end. Make sure to check out our other educational webinars.